Listen to this warning.
The world economy is in crisis right now, not only in America, but Europe's in serious trouble and Japan's very serious trouble.
Kiyosaki is not the only one raising alarms. The ITR Economics, one of the few firms that accurately forecasted the 2008 recession years in advance, published a bold projection. A major economic depression could hit the US as early as 2030. And while that may sound far away, the warning signs are already flashing.
Do you believe that the U.S. is headed into another Great Depression?
I don't think it's going to be a Great Depression, but I believe that we are heading into a very, very severe recession.
Well, basically the same thing, because the same problems that I correctly observed in the years leading up to the '08 financial crisis, they're here today. It's the same problems.
Inflation is proving stubborn. Debt is piling up. Investor confidence is eroding. Add to that the rising climate stress and the geopolitical tensions. And then came the spark that could make this fire even worse.
In a few moments, we're going to make official the greatest victory yet when I sign the one big, beautiful.
As per the experts and major research houses like the Congressional Budget Office, CBO, one big beautiful bill slashes government revenues by $4.5 trillion and is expected to add another $3.4 trillion to the national debt over the next decade. The point is that at a time when the US national debt already exceeds $37 trillion and the bond markets are showing signs of stress, this bill has ignited new fears. So the question is, could this new law, combined with the rising debt, inflation, and global uncertainty, act as the final catalyst to send America and maybe the world into another Great Depression or at least a severe recession? Let's find out. Let's start with the debt. So if we believe the projections of the Congressional Budget Office, the CBO, the Tax Foundation and some other independent analysts, Trump's one big beautiful bill will make our debt picture even bleaker, adding roughly $3.4 trillion to the national debt by 2035. This is because the law makes permanent many of President Trump's 2017 tax cuts and introduces fresh tax breaks for households and businesses, and plans also to boost the spending on the military and the homeland security. You might say, but won't those tax cuts put more cash in people's pockets and boost the GDP? And yes, that's true, at least at first. According to the CBO, this law will give the economy a short-term lift as people will have more take-home cash which they might spend on buying goods and services. And this will peak in 2026 when the real GDP will be almost 0.9% higher than it would have been without the big beautiful law. Now that boost comes from, of course, people and companies spending their extra after-tax dollars and from firms accelerating investments thanks to the general write-offs by the government. But here's the catch, that lift fades away pretty quickly. First and foremost because these tax cuts will have huge fiscal costs. This means the government will have to raise more loans to finance the provisions of this new law. This will add to the already existing huge debt of the government. And as we talked about, this is almost $3.4 trillion in the next 10 years. Hence, it's certain that the debt will rise significantly due to this new law or the big beautiful law. Now coming back to a video, let's see how this new law, which significantly raises the debt levels, actually turns out to be the catalyst of the next depression or at least the next severe recession. See, the US government raises money by issuing sovereign bonds or the treasury bonds, which are sold to investors like pension funds, central banks, insurance companies, and even individuals like you and me. These bonds are auctioned regularly by the US Treasury, promising to pay investors later with interest. Now, there are short-term as well as long-term bonds which mature in 2 years or 20 years or 30 years respectively. Short-term for 2 years and long term, which mature in 20 years or 30 years, right? But recently, something unusual and worrying has been happening. Bond auctions have begun to show weak demand, especially for the long-term bonds like the 20 and 30-year notes. Because of the weak demand, the interest, or as we call it, the yield offered by the government increases. Because the government has to offer more interest to lure investors to buy government bonds. For instance, in May 2025, the 20-year yield crossed 5.05% just to lure the investors. Similar resistance was also seen in Japan in June of 2025. This weak demand means the US government now has to pay more to borrow money, and that drives up interest costs rapidly. In 2024, the US spent more on interest payments than it paid on defense and Medicare expenditure. Now see, investors were showing signs of distress with the US tax bill. Now when the bill has become a law, it is expected that the confidence of the investors is going to further exacerbate. This means even more interest payments by the US government to lure the investors. Foreign central banks, which have long been the biggest buyers of the US Treasury bonds, are stepping back. China, Japan, and European funds are slowing purchases or demanding higher premiums for the perceived risks from the US Treasury bonds. This is well testified by the recent report, which indicated that over 200 central banks and foreign entities have collectively sold off approximately $48 billion in treasuries since late March 2025. This trend is notable because central banks typically increase their US debt holdings during periods of weakening dollar. But this year, they have been the net sellers of the US Treasury bonds despite the dollar's decline. This combination of growing debt, rising borrowing costs, and weakening investors' demand can spark what economists call a debt spiral. See, more debt leads to higher number of US bonds issued by the US government. Higher supply of the US Treasury bonds leads to higher interest payments by the US government to lure the investors. Now, this higher interest payments further widens the US deficit. A wider deficit means what? More borrowing. And this loop continues. And no, printing more money is not a solution here. Sure, the government can technically create dollars, but using printed money to repay debt can lead to inflation or worse, hyperinflation, which destroys the value of savings, wages, and dollars itself. Like your 5 lakh US dollars retirement funds, which might get reduced in value to mere 1 lakh US dollars. Just ask the countries like Zimbabwe and Venezuela, or Argentina for that matter. For those who don't know, inflation happens when there's more money chasing the same amount of goods and services. If the government prints money out of thin air without creating real economic value, prices rise. Because while the cash supply increases, the supply of products does not. This erodes the purchasing power. The value of every dollar in your pocket drops, savings shrink, wages fall behind. And in extreme cases, it leads to hyperinflation, like we saw in Zimbabwe and Venezuela. Now, if this debt spiral that we talked about continues like this unchecked, the US might even face the unthinkable default. Now, a default happens when the government either cannot or won't pay back its bondholders on time or its debt holders on time. This can happen when the government does not or cannot increase the debt ceiling. And stay with me, a debt ceiling is a legal cap on how much the government is allowed to borrow or pay for things it has already committed to, like social security, military salaries, or interest on the national debt. When the debt ceiling is hit, like it was in 2011 and again in 2023, the government cannot borrow more unless Congress raises the cap. And if Congress cannot agree, the government runs out of money. Not because it is bankrupt, but because it legally cannot access more funds. And here's when things get more worrying. Some experts now warn that a US debt default could come as early as August or September this year.
In breaking news, the Congressional Budget Office warning that the federal government could run out of money to pay its bills on time as soon as August if lawmakers fail to raise or suspend the debt limit.
And that's not just a technical problem, it's a potential global shock. Because the moment confidence in US Treasuries vanishes, everything from mortgage rates to global investment flows could start to unravel. Could the US actually default or be forced to print money, which can cause a depression? Let's talk about the big fear. Could the US government actually default on its debt? Or worse, be forced to print money just to stay afloat? Here's the context. This would only happen if Congress fails to raise the debt ceiling. Now, will that actually happen? Highly unlikely. Congress has raised the debt ceiling over 70 times since World War II. But here's the bigger issue. Raising the debt ceiling just gives the permission to borrow. But what if investors stop lending? That's the real concern. In the past, US Treasuries were the gold standard. Because the US dollars is the world's reserve currency, countries, central banks and global institutions lined up to lend. But that trust is now eroding, especially after Mr. Trump joined office. The confidence of investors on the US system altogether, like bonds, policies, frameworks, has shaken. This is due to a number of questionable and uncertainties spread in a very short span of time, including the tariffs, the attack on the Fed, open threat to inflate away the debt or force creditors to take long-dated bonds, effectively a soft default. Add to it the controversial Big Beautiful Law. If investors lose faith, the US might struggle to sell enough bonds at all. That's when Washington might lean on the Fed to monetize the debt. In other words, print money to cover the deficits. This leads to inflation, or worse, damaging the dollar and pushing borrowing costs even higher. So here's the bottom line. The US is not just battling rising debt or interest payments. It's confronting a crisis of confidence, both at home and across the global markets. And now with Trump back in office, uncertainty is accelerating. His one big beautiful law adds trillions to the debt. His attacks on the Fed, threats to inflate the debt away, and aggressive tariffs on rivals and allies alike, they all send one message to the world. America might no longer play the rules it itself created. And when you shake investors' faith, especially in the US Treasuries, you don't just spark a financial panic. You threaten the very credibility of the US dollar itself. Think about it. The dollar has been the world's reserve currency for nearly 80 years, not just because of economic strength of USA, but because of the stability, predictability, and trust of the US economy. But now, the bond markets are flashing warning signs, global investors are pulling out, even central banks are dumping the US debt, and confidence in America's long-term leadership is eroding. If that trust breaks, if the world stops believing in US bonds and the dollar, the fallout won't be limited to Washington. It could trigger a global chain reaction from currency devaluation, rising inflation, to a full-scale economic depression. So the real question is no longer will America default, it's this. What happens if the world stops trusting the dollar? Because when that moment comes, it won't be loud, it won't be announced. It'll be a silent exit of capital, of confidence, and of control. And just like in 1929 or at least 2008, it will feel like it happened all at once. So stay with me in the next video. We'll break down on what actually happened in the Great Recession or the Great Depression of 1929. What are the reasons of a depression of that scale? Thanks for now. Please like and subscribe my video because it helps to motivate me. Thank you.